minutes before time actually, so that we don't take any of the times of the panelists. Before I call upon the panelists, let me briefly tell you what's happening in MMA next few days so that you don't miss any of these events. And what is happening on 31st, next event, is a joint event with the International Advertisement Association. Talk on Voice of Change, Gender Portrayal from 30 seconds to 3 hours. We had some outstanding faculty, outstanding panelists to come and discuss on gender parity and women empowerment and what exactly it means where our over 50% of our population is women, now they are getting empowered. How they are doing so well, and the recent report has always said 60% of the women said they are getting equal pay than men folks of equal job what they are doing in their organization. So things are really looking up very beautifully, so you must come and listen to it. Then on 4th of September, we have again startup and opportunities and excitement. This is a startup series what we do. Dr. Tamaswati Ghosh is the CEO of IIT Madras Incubation Cell. She'll be leading a conversation with Prabhu Rajagopal and Manu Iyer. Then on the 15th of September, we are again event on talk on Touch the Sky and Beyond. This is we are doing jointly with Vicky Flo. Srimati KAS, founder and CEO of Space. She's done some phenomenal work for Space Kids. Jennifer Arul, you all know, former anchor. And Muthuvel Narayanan, she is again very good, represent national level in some of the sports, and scholar Unni will be leading the conversation. Then on 16th September, the mail has already been sent to you today. Cabin Care MMA Chindication Innovation Award. And you must come and see to the 3 outstanding innovators who are going to be honored on that day for their outstanding innovation. In fact, we had the innovation jury meeting yesterday. We had over 220 nominations and where we have shortlisted 3 of them. And I can tell you, we are in the safe hands. Phenomenal startups, phenomenal story of innovation, and people think so differently. And I urge upon each one of you to come and attend this event. Is one of the finest event which organizes by MMA along with Cabin Care. It's happening at IIT Research Park Auditorium, 6 o'clock, followed by dinner at the same venue. And Suresh Narayanan, Chairman, Managing Director of Nestle, has kindly agreed to be the chief guest, and he'll be also addressing all the gatherings and all the participants there. On 20th September, we have again startup and opportunities and excitement. Again, 3 outstanding startups. Devanshu from Solinas. Swastik Soro Dash is a new motion company, and Sujata Srinivasan, Professor, Department of Mechanical Engineering, will be leading the conversation. We already do a lot of work, startups, so that to inspire not only existing people who are entrepreneurs, also large number of students and entrepreneurs come and listen to this. And I could see the number of interest for the event today. I am quite sure even each of our events will pick up same interest. 21st September, we have a success story of what was done. Again, an outstanding success story. Mr. Mahadevan, founder of Heartbreads. You all know, very popular as Heartbread Mahadevan. From a professor of a college to what he has done today and what he is doing and what is the insight, how we have gone all over the world. You must really come and listen to him. And Mr. Mahalingam, President MMA, will be leading the conversation with him. On 22nd September, again, we have Read and Grow, which we do it for the students. Then 28th September, again, very good event. Discussion on the theme of the book, which is authored by Mr. Ajay Chaudhary, co-founder of HCL. And again, we are lined up some outstanding panel along with him. On Saturday, 30th September, Busting the Management Myth is a discussion. Again, we have an outstanding international faculties, international thought leaders. Peter D. Jagger is come from Canada. He's going to be there. Ashok Sutta, founder of Mindtree, he is going to be there for this too. Shamla, and also we have some outstanding panelists will be joining us. Then on 4th of October, yes, my time is over. 4th of October, we have MMA All India Management Student Convention happening at IIT Research Park Auditorium. We expect over 1,000 students to attend, and we already have more than 600 nominations filled up. And please do come and join us for all the events. Not able to come, not to worry. All our events are webcast live on YouTube, live on Facebook, and many more. Ladies and gentlemen, today's event, stock market, overvalued or what? We don't know. We have got some outstanding panelists who are going to give you problems, solutions, many things. I know the way the hall is full, you're all expecting a lot of tips so that you can make quick money. I don't know if that's going to happen or not, but nobody who's ever got a tip, I'm quite sure never made money in stock market. Stock market has got so many things, and a lot of people keep telling me, you stay invested. I stayed invested only. My thing is stay invested in the same place where it was. maybe I am not armed forces guys. They all know you because you are getting good pension from government. Why you very stay invested, stay there where you are. But anyway, to listen to this topic, we have a very outstanding panel. Let me have the privilege of please put your hand together. Welcome, very outstanding panel. Ganesh Jayaraman, Managing Director, Head of Avendus Park Institutional Equities, Chennai. Mr. Sunil Subramaniam, Managing Director, Sundaram Asset Management Company Limited. Mr. Nishit, Master, Fund Manager, Axis Securities Limited. And all the three panelists will be in conversation with Ms. Vidya, Bala, Founder, Partner, Head, Research Product of Prime Minister Limited. Very warm round of applause to distinguished panelists. May I request the panelists please take their place on the dais. Yes, please. Vidya, Sunil, Nishit, and also Ganeshram. Ladies and gentlemen, we have warm round of applause to the distinguished panelists. The more the applause, I can assure you, you will get some great insights. It's very important to encourage the market as well as encourage. Before I introduce the distinguished panelists for this evening, let me have the privilege of welcoming my President of Madras Management Association and also partner TSM Group of Companies, popularly known as Mali. Mali is also an active angel investor. Is a regular speaker, guest lecturer in number of institutions, and is also in number of educational institutions and public organizations like Brahmagana Sabha, Children Club, and many. And he's also past Secretary of IIM Alumni Association. He is our President for the Madras Management for the current year. Now I request Mr. Mali to please deliver the formal welcome address. Mr. Mali.
Good evening, everybody. Distinguished, a very warm welcome on a very warm August evening. I was walking in, one thing struck me. Maybe few things in the world, maybe particularly in India, attract a wide cross section of people. I can see the room full of people across age groups, students, stock market enthusiasts, and laymen like me. I think the hall being full for a standalone event like this is a real tribute both to the topic and the people on stage. Thank you. So formally, it's really indeed an honor for me to extend a warm welcome on this the evening on the intriguing topic. Intriguing is the right word for me. Like Vijay Kumar, I've never figured the stock markets out. Okay, so every time I entered, it kind of went down. So I tell people don't invest when I get in. Okay. Stock market overvalued or what? So over a period of time, I've been a little luckier than group captain. I've left it to the experts and not lost money for sure. Okay, and made some money. So I think it's best left to the experts like you. So that's why for this evening, we have a panel of experts like you to discuss whether the stock markets are overvalued or what. And I'm privileged to extend a very hearty and warm welcome to our esteemed speakers. Mr. Ganesh Jayaraman, Managing Director and Head, Avendus Park Institutional Equities, Chennai. Thank you. Thank you for taking the time. Mr. Sunil Subramaniam, Managing Director, Sundaram Asset Management Company. Thank you again, Mr. Sunil. Mr. Nishit, Master, Fund Manager, Axis Securities Limited. Somebody I've met before also. A couple of them I met before. And Ms. Vidya, Bala, whom I met this evening, Founding Partner and Head, Research and Product, Prime Investor.in. Thank you, all of you, for taking your time and gracing this occasion. I think we are all very lucky at Madras Management. The audience is also very lucky to have a panel like this and to listen to you and learn and unlearn, is what I would say. Yeah. My greetings all to the attendees of graced presence, including delegates from investor associations, MMA members from various chapters across Tamil Nadu and Pondicherry, partners and affiliates, as well as all of the numerous participants joining us virtually. This is something which has really caught on since COVID. We have 1,000, 2,000 people attending this online, and that viewership only goes up as we go along. A brief view of MMA. It's established in 1996. MMA is involved into one of the largest management associations in the country. I think it's the largest management in the country, boasting over 8,000 members across 10 chapters. It has an honor of being bestowed the prestigious title of Best Management Association in the country by All India Management Association for 13 consecutive years. Coming to the topic, I think throughout 2023, the Indian stock markets have really done very well. There are many reasons attributed to it. The fastest growing economy, the lone shining star in an otherwise depressed world. Some even quotes saying India overtaking China in population is actually an opportunity and not a threat because of potential demographic dividend. As I said, I don't think, at least I don't understand much of this, why it goes up or why it goes down. So I think we'll leave it to the experts, I said earlier, to discuss this, delve deeper, and I'm sure at the end of it, give us enough insights of what to do, at least definitely what not to do, and why things happen, why things don't happen. I also extend a warm welcome to our past presidents, members of the management committee, fellow MMA members, distinguished minorities, and enthusiastic management student participants. As I mentioned earlier, as I was coming up the stairs, I had to wade my way through a crowd of students. Yeah, hearty to see so many students. Thank you all for coming. A special greeting for all those online viewers who are joining us from across the world through YouTube, Facebook, and MMA Live webinar. As I said earlier, I'm sure we'll all, at the end of this evening, thanks to what we're going to hear from you and get from you, we'll leave wiser. And I promise it to be, I think it promises to be educative, informative, and exciting evening. Thank you again for all of you taking your time.
Thank you, Mr. Mali. I think you found a good expert. I have to find an expert to find another expert, actually, while investing. Thank you so much. And before I call upon the panel to start the discussion, let me have the privilege of introducing distinguished moderator who is going to lead the conversation, and also all the panelists. Vidya Bala, founding partner, head research product of Prime Investors Limited. And Vidya Bala built one of the country's earliest robo-advisory solutions in the country. In her earlier role as a fund India, she believes in not just providing the right solution for investors, but also taking ownership for the same and following it up with changing course when the situation warrants. And Vidya is head of mutual funds, research fund India, where she did some path-breaking work, analyzing fund offers and research portfolios. And she is more than 18 years of experience and over 15 years spent analyzing the market. Vidya is known in the media for her straight talk and calling out bad products. Very warm welcome to Vidya. It's a pleasure to have you with us, the moderator for this evening. Let me have the privilege of introducing Mr. Nishit Master, is a fund manager, Axis Securities Limited. And Nishit is diverse experience in both buy side and sell side. Firm brings in a fresh perspective on the market of Axis Securities, and Nishit has over 18 years of experience in the financial service industry and has worked in various companies before joining the present assignment. And Nishit is a forum certificate holder and management graduate, an MBA and from Mumbai, and his acute sense of understanding the business models and picking up outperformers amongst the investable universe is very talent what he possesses. And very warm welcome, Nishit. Pleasure to have you with us this evening. Let me have the privilege of introducing Mr. Sunil Subramaniam, Managing Director, Sundaram Asset Management Company Limited. Sunil has a Masters of Business Administration from the Open University of Business School, London, and is an MSc graduate from IIT Madras, and is also a Certified Associate of Indian Institute of Bankers. In his tenure around over 15 years, Sunil has handled various responsibilities through which he is instrumental in expanding Sundaram Mutual footprint both domestically and internationally. And Sunil has been recognized as the Economic Times as one of the most promising business leaders of Asia for 5 times in a row, 18, 19, 20, 21 and 22. Very warm round of applause. And under his leadership, Sundaram Mutual Fund has won several accolades. Pleasure to have you with us, Mr. Sunil, this evening. Let me have the privilege of introducing Mr. Jayaraman. He is a Managing Director and Head of Avendus Park Institutional Equities, Chennai. Ganeshram is over 100 plus members of institutional equities team and business. He wears 2 hats and he leads India's top ranked strategy desk advising CIO and portfolio managers on the Indian portfolio, engaging with senior management and business ecosystem at large, connecting dots between the top down and bottom up help him to go ahead with the curve of the constraint what he faces. Ganeshram joined Spark in his first profession in 2006. Prior to that, which he was credit analyst with HSBC, Standard Chartered Bank, and leading the bank large corporates. He is also a CPA, remain deeply passionate about family, food and cricket. Family and cricket, I understand. How is passionate about food? We want to learn from you later, sir. And very warm welcome to distinguished panelists. Ladies and gentlemen, we are going to have a very thought-provoking event. All the viewers watching this program live, as usual, if you have any questions. Please send your questions as usual to the numbers which is flashed on the screen. All the viewers here will pass on the question slips. Please write your questions and your name, and it will be passed down to the moderator. We're not putting the microphone around because of paucity of the time. I hope you understand, and thank you for understanding. The questions will be passed on to you. Please be ready with the questions so that all your questions will be addressed to them. Please address them to the panelists for the topic. What is there today only, nothing else. Thank you. Over to you.
Good evening, everybody. Good evening, gentlemen. Thanks, MMA. Thanks, Captain, for the kind introduction. I liked one of the terms used. A previous speaker said, "Learn, unlearn." I think today's discussion will be all about some of the things that you learn and some of the misconceptions, if there are any, that you will unlearn. So I'm quite hopeful about that. Before we start, the topic of this session is very straight. Overvalued or what, right? It's almost like answer me. That seems to be the kind of title we have. But before we go to that, I'd like to know how many of you, after all, this session is for you all. So I want to know how many of you here feel that the market is overvalued. Can you please raise your hands? I'm surprised. The students, please, most welcome. Market is nothing short of gambling, so feel free to vote. Right now, at least. Please feel free to vote. Okay, this is surprising. We have very few people who have said that the market is overvalued, and that essentially means the others want the markets to go up. It's as simple as that. The moment you say the market is overvalued, you don't want you are just being overcautious and you don't want to invest anymore. So it's great to know that most of you here, in the sense that you are investing and you want the market to grow, right? We're all here because we want the market to grow. But let's see if that's the case. So at the end of this session, I'm going to take a vote again and see if the views change. Please remind me if these people, this panel has influenced you. Oops, I'm sorry, influencer is not a good term anymore. But let's see if they remove some of the misconceptions or they validate your reasoning. So Nifty, not at 20,000 right now, 19,300. Markets have moved at a very sharp pace, but still the 1 year return is at the Nifty return is at about 11%. The valuation, because we are talking of valuation here, trailing valuation at about 22 times. FI24 valuation at about 20.6 consensus. And about 17.5 for FI25. That's where the valuations stand, right? So these are the figures, and earnings growth of the Nifty 50 companies have been in double digits. Just when we all thought commodity prices had abated and it started contributing to margins of India Inc., and just as we thought inflation was getting better, there are now some worrying signs. We all know that you don't have to watch the market to know it. We all know it from the price of our vegetables, right? That the market, is worried about the inflation and what the RBI is going to do, in its monetary policy, because everybody had started expecting a rate cut, at least somewhere down the line. But these initial signs can be a bit worrying. The other thing, of course, is exports have been on a decline, right? There are many other factors that actually work in our favor, but I'm just talking about some of the worrying factors which we thought had abated, right? So this is where we are. So we have a mix of double-digit growth, financials, auto, consumer discretionary, really going great guns. People are buying like there's no tomorrow. There is the talk of premiumization happening. People are buying expensive goods in the car, whether it's two-wheelers or four-wheelers. There is premiumization happening. That's what the latest, keyword is. So all that is happening, but we are concerned at some level. So that's why we are here today. So, but each of our concerns may stem from what we understand, as being overvalued. So, my first question to the panelists here would be, what each of their, perception of overvaluation is, and by those, metrics, whether the market is overvalued today. So, Sunil, can you please share your perspective on what is it that you typically look at to say the market is overvalued?
Is the question of me as Sunil the investor or the question of me as Sunil the asset manager?
If both differ, I'll come to the individual in you later, but since you manage people's money, let's look at that first.
So, I don't have the luxury of thinking if the market is overvalued or not. Why do I say that? Because if I feel the market is overvalued, I should return my investors' money back to them. Because I cannot take an equity money and put it in debt. I cannot take their debt money and put it in fixed deposits. What an investor would do if he felt the market was overvalued was to shift out of the overvalued market in his mind and go. As a fund manager, I do not have the luxury. So then what's my answer to that question? So I think that valuation is a very relative term, number one. Number two, investor returns are not correlated to valuations. I want to make this fundamental point. Why do I say this? Because investor returns are made from two separate aspects. The cost of production of a commodity and the price the market is willing to pay for the commodity. Right? Stocks are nothing but a commodity. So you take potatoes as a commodity, there's a certain amount of input cost. The potato farmer says that 20 rupees is the cost of producing the potato. Does the market give him 20 rupees always? It either gives him 2 rupees or gives him 100 rupees. Right? So the cost of production is the EPS growth. The market's value is the fundamental discounting of future cash flows of companies. But does the market respect those fundamentals? Not necessarily true. It depends on demand and supply for that commodity. Depending on whether there's a drought versus there's a flood versus whether competitors are sowing potato in the field. Like that, the opportunity cost of money to the investor who drives the market, not you, but the person who's making the market's prices go up, does he have other opportunities to put his money in, decides what price he's going to pay for your product. That's a commodity, right? So Indian markets today, Indian stocks are in a situation where our fate is not in our hands. It is a large chunk of FII money which owns anywhere between 35 to 40% of the free float stock of our capital markets, who decide to put money in our markets. And for them, instead of putting in a losing country like the US, instead of putting it in a country like Brazil, India is a better alternative. Regardless of what your EPS growth is, as long as it's better than the return expectations there. So to me, to judge the market's valuation on where I put my money is to look at the big investor there, the big brown bull, I will not say bear, right? Who's going to put money and look at the situation. Now, when does he put money in India? He puts money in India when his cost of borrowing from the advanced countries is low, when the chance of rupee depreciating vis-a-vis those countries is low, and third and foremost for India, it is when the cost of oil is trending down, because we import 83% of our oil requirements. So it is those situations which decide whether FII money would flow into the markets in the future. That's the second point I want to make, is that why I said that I don't have the luxury, because to me, customers give me the money with a 3 to 5 year outlook. That is the assumption on which I do. I know customers come in with shorter term time frames, but I cannot assume that. So when they give the money, and to me, the market valuations that we all refer to are 1 year forward. But I am looking at my investee company's returns 3 years forward. So 1 year forward, it might appear to be over expensive because he's investing in capex. His interest costs are shot up, his earnings are down. But in 3 years' time, those capital expenditures would pay off, And so it's worth investing in that. So for me, it's the average of the FY27 to FY30 EPS of that company, which makes my decision on whether that stock is overvalued or not. So it's very hard. The second aspect is market is equal to Nifty is equal to Sensex in people's mind. For me, market is a weighted average of the Nifty plus the BSE mid cap index plus the BSE small cap index, because customers give money in these funds. So it's the overall weighted average 3 to 5 year forward PE of the stocks in my portfolio, which decides my view on is it overvalued. And if it's overvalued, like a few of my competitors have done, I will shut my flow into certain specific funds. Like somebody shut it into a small cap fund because he feels it's overvalued. He's not taking the money. So I think the simple answer to that is that what is disclosed as PE trailing and 1 year forward have no relevance to the investment decision itself.
So, we will probably come back if, Mr. Sunil's point is that, I mean, as retail investors, handling retail investors' money, he's looking at the long term. And from that perspective, unless he has concerns, he would have to, of course, do his job of doing the right investments for customers. Ganesh, of course, you know, the nature of, the people you deal with and the audience is very different. For you, call between holding equity and, holding cash can be very crucial at times, not just to get higher returns, but to protect downside. So from that perspective, what typically, are the signs for you that there is bubble, and what would you do at such times?
Good evening. I'll look at markets now. It's a bit of an enigmatic market. Okay, the long-term picture is very attractive. The 5-year view, the rest of the decade view on India looks mouth-watering. In the sense, I've never seen corporate balance sheets the way how healthy they are today. I last saw it in 2003. Okay, the extremely low levels of debt, the capacity utilization, the likely capacity expansion. I was in Gujarat last week across Vapi and Surat. Must have met about 30 small and medium enterprises managements. Each one of them told me that they are looking to increase capacity. These are in textiles or chemicals or related ancillaries. Not only are large corporates, but even small and medium are telling me that. Okay. You are looking at larger long-term trends like demographies, as somebody said, urbanization, or the government's priorities on the whole China Plus One and PLI and all the manufacturing improvements that we are seeing on the ground. One drive to Sri City, 60 kilometers away, will all tell you what this is. Okay, I mean, it in almost like one locality, right? You will have 300 companies with manufacturing locations there, and they are not only catering to exports but also local demand. So the long-term view on India's potential earnings growth looks very healthy. My short-term view, next 1 year, 18 months, I am not comfortable in the markets. I see consumption moderating. So to answer your question, what is my key concern? It is consumption. Okay. For the last 10 years, say from 2010 to 20, there was no capex cycle in India. Okay. Exports grew more or less, it didn't expand dramatically, but the economy was led by consumption. Okay. My concerns are post-COVID, the way our consumption is recovering is not looking healthy. I'll give you some examples. Two-wheeler sales. FY23 sales are below FY19 sales. Staples, consumer staples, it's hardly kept pace with inflation. Okay, volume growth, low single digits. Take categories like white goods, consumer durables, kitchen appliances, liquor. I can name 10 consumer categories where the growth is just not adequate enough. There is a commonly used word in our parlance, it's K-shaped. Okay, 80% of the consumption is mass consumption. That's not growing. I'll give you an example. Passenger cars. Cars priced below 7 lakhs. FY18 to FY23. FY23 has declined. Cars priced above 7 lakhs have grown 50%. Okay. So SUVs and premium cars are growing. Mali will know more than me on this topic. Okay. So the broader point is I can do this. Take categories like apparels, watches, liquor. I can name maybe 10 categories of consumption where the mass consumption is just not growing. Okay. So to answer your question, what's getting me wary is earnings moderation, growth moderation, and multiples that we pay are not recognizing moderating growth. So the long-term demand drivers, employment, salary hikes, on the macro side, IT is not hiring. Okay, 3 consecutive quarters, IT sector has shed jobs. Cities like Chennai, Bangalore, Hyderabad, Pune, NCR, IT is a very important driver of jobs and consumption. Okay, you can walk around your families and friend circles. IT drives a fair bit of our economy in India, especially not in Mumbai, but in metros in other parts of the country. IT is not hiring. Second, exports have declined. Okay, as Vidya started out. So inflation is, rural inflation has been more than rural wages. So in other words, the consumer is prioritizing spending on something else or not on discretionary consumption. And the way the COVID has evolved and how the recovery has played out, this is hurting the earnings growth which we are penciling in. Last 6 months, we saw a phenomena where volume growth was not kept pace, but commodity prices cooled off. And that led to margin expansion. That's why we have seen markets recover this year. Is it sustainable? I am not good at predicting where oil will be, where steel will be, where coal will be. I am not good enough. What I look for is stock price, likely comfort zone on earnings expectations, and is the stock in my frame, in my margin of safety, as we call. Is it in that consumption sector not comfortable? What is comfortable? Very comfortable, even though they are expensive, is the whole capex cycle. Okay, as I said, large companies. One phenomenal trend in India, and maybe I'll come back to you as we come. But long story short is the capex cycle is where I am quite confident of. I'll come back.
So, from what Ganesh says, he is concerned about certain segments. So that is where, stock specific investing comes in. You can't make assumptions about the general market and invest. So there are segments, we will come back again, which he is bullish about, and we might want to take more insights on that. So we'll move to Nishit. What is the sense that you are getting at present from some of the macro factors that we are seeing, in the market, and their influence on where the markets are headed? The other factor, of course, that will be playing on all your head is the upcoming election year. And the current valuation at which we are. Do both of these together concern you?
Thank you. So, multiple angles to it. If you just plainly look at valuations, and if I look at 1 year forward multiples on a PE basis, we will be at, say, around 18 times 1 year forward. Historical average, last 15, 17 years would be around 16 times. So we are close to 1 standard deviation above average. But if I look at from a different multiple, which is price to book value basis, we would be at around 2.7 times 1 year forward. Historical average for last 15 years will be 2.6 times. So not much different than last 15, 17 years average. One more parameter which we typically use is the beer ratio, which is the bond yield upon equity earnings yield. And in that, historical multiples which global investors look at is one. But Indian markets typically have traded at around 1.2 times. We are currently at 1.35 times. So, which means that probably bonds are slightly more attractive in terms of valuation than equities. But now all this is under a backdrop where, as Sunil said, right, it's about what options do you have as investors. Now, if I look at the macro setup, most of the major economies, so Europe probably is already in recession. US is slated to be in recession probably next year. China, after a expectation of a big bang revival from COVID opening up, has that big bang revival has not materialized. So, you are looking at probably anemic growth even from China. So for global investors, there are hardly few sizable markets where they can invest in, which are, expected to grow. So no matter what GDP growth estimates one takes, right? RBI, World Bank, IMF, everyone at least says that India is expected to grow by more than 6%. Now, if that's the case, I don't know of any major economy which is expected to grow upwards of 6%. And in an environment where growth is slowing down globally, anything which is in shortage will attract premium. And that's why Indian markets are at premium. So yes, if I look at pure valuations, then yes, we might be slightly overvalued. But I think to some extent, there are factors which support this overvalued markets of ours, especially because there aren't alternatives available for global investors to invest in. That does not mean that we might not have corrections. A 5% correction, a 7% correction here and there is part and parcel of equity markets. One that can happen at any point in time. Most likely, the trigger could be something happening outside India rather than in India. From an election perspective, as long as market factors in stability of policy from the government, then whoever is in the government does not matter to the market. We believe that with the momentum which we've seen in the last few years, policies will be difficult for any new government to change. The pace can slow down, but it cannot be reversed. So from that perspective, we are in a far better space. And if I look at the corporate leverage as well as the banking system health, I think we are at a far better position than what we were earlier, as Ganeshram mentioned earlier. Right? This is not what we've seen in last 15 years. Amongst the best level of balance sheets amongst Indian corporates and bank balance sheets which are extremely clean, don't require capital to grow for the next few years because you're still looking at 16-17% credit growth. So, yeah.
So going by Nishit's valuation metric, we are a little drunk going by the beer ratio that he uses. Even by, the great Warren Buffett's market cap to GDP, I don't use it, but, India, so that some of the metrics that are used globally, if applied in India, sometimes always, makes India look overvalued. But that's a separate topic. Speaking of, the index being overvalued, the valuation, because Nishit mentioned about long-term averages. I want to just make a point on commentaries that you read in the media when you look at the price earnings ratio, because that's typically what, most of us look at, when it comes to whether the market is overvalued or not. We need to keep in mind the changing composition of the Nifty 50 index, over the past decade and a half, right? Earlier, so when we speak of, valuations of 15 to 18 times in the past, what was the composition of the index? We had very asset-heavy companies. We had companies with, debt-laden balance sheets, very highly leveraged, debt-laden balance sheets, asset-heavy, and lot of cyclical companies, right? So these companies typically have never commanded high valuations, and when they dominated the Nifty index, the valuation too was at a range that may no longer apply with the changing composition of the index. I think that's something that we need to keep watch when we look too much into the past. For example, now, in the past decade or so, you have had financials, much of it being private financials. We have had IT, and we have had consumer FMCG. All of this, look at the nature of these companies. Majority being asset light. Of course, financials is a slightly different kind of an asset, but if you take IT, FMCG, asset light, very clean balance sheets, cash rich, right? Very different, balance sheet and asset makeup, and more steady in terms of the growth that they have delivered. Now, the changing PE ratio, of the Nifty per se, if you have to look at, has to be seen in this light is, one point that I wish to make. So going by that, there is a reason perhaps why the market has been affording 20 to 22 times valuations for a long while now to the, Nifty 50. And it's not like it's not been overvalued. If you take, sometime around June, July 2021, we were at about 29 times. Right? And since the earnings have seen improvement, and it has come to about 22 times trailing. Again, it's all the past, but I'm just trying to tell you that the overvaluation zone itself has moved, and then, the average zones may also have, changed. So when you look at price earnings ratio, I think over at least every 5 years, it's important to take a relook at the index. Having said that, I think overall here, we are kind of mixed in our view with the first question. Ganesh and Nishit are kind of cautious. Sunil and I are optimistic. I might say I'm cautiously optimistic to, just to cover myself up. But having, said that, I think irrespective of where the markets are, all of us will agree we will have to continue to scout for opportunities. There is no denying that, because you have been given the job and we have been given the money to do that. And as investors, you have the money and you will continue to scout for opportunities. So when it comes to opportunities, let's take some segments. I took some, areas where I thought there could be opportunities or there could be threats. So let's hear from the gentleman on these aspects. So Sunil, I kept referring to the index, much of the time, but we do know, the IT or the FMCG sectors are now so large that for them to grow well beyond the GDP growth is a bit of a challenge. And then there are sectors which are now contributing a lot more to the GDP, which is, manufacturing, etc. So if you want to focus on returns of, Indian companies versus just index returns, where would you look beyond the traditional index returning sectors?
Let me take off from the last answer that I gave. I only answered as the head of the asset management company.
Sure.
The answer I want to take off to answer this question is what I do as an individual investor. And the answer to that is I ignore valuations. Okay. Why do I say that? Because what's the purpose of investing, right? The purpose of investing is to create long-term wealth. Long-term wealth creation happens when you beat inflation, right? And arguably, India is a 7% investment land, in inflation land. When you take past 15 years, maybe it's at 6 now, but on average, if you take 7, and if you look at equity is the only consistent asset class which can beat inflation. So your asset allocation based on your risk profile, of course, should always be to use equity as your wealth generating asset class. How much you put depends on your risk profile. Having done that, right, when you choose equities, I'm saying valuations don't matter because your allocation to equity should be consistent regardless of where current market is pricing those earnings. And why do I say that? Because whether it is the average PE, whether it is the average earnings underlying that PE, whether it's the average compared to long-term average, The average is the worst possible statistics in man's history. It's like saying the Kaveri is on an average 5 foot deep, and hence I will take the risk of walking across the Kaveri. Right? It is the fact that somewhere it's 10 feet and somewhere it's 3 feet. So the average represents whether you take mean, median, mode. And the point is that if you can select within that average, that which is going to deliver returns at any market valuation, you can pick those stocks or sectors or indices which can deliver to you better, because they are the component of the average which is taking it up. So when you then look at valuations and look at this, try and look at what was the previous peak valuation, what were the conditions prevalent at that point to make the valuation go, and in my investment horizon, is there a chance that would happen? Right? So if you look at it, people use standard deviation and all that, right? In December 2017 and October 21, the market was trading at more than 2 standard deviations away from the mean. What were the conditions then that prevailed, right? The conditions prevailing were a demand for Indian stocks, right? And if you look at India's future, based on what even my other panelists have said, right? The demographic dividend, the capex driven cycle, then India's growth for a very long time to come is kind of assured, and hence India as a market will deserve a premium from a foreign investor. So that premium may vary up and down, but that premium is going to deliver you the returns as an Indian investor. So ignore valuations, and if you then say, okay, I want to go outside the index because index is 34% banking and financial services, the large cap index, right? Now, if you take the small cap index, it's industrials heavy. You take the mid-cap index, it's consumer discretionary heavy, right? So all you then need to do this is to take your portfolio equally across the 3. Do a multi-cap oriented thing. The only thing you should bear in mind is that if you are doing any sectoral allocation, look domestic rather than look outside, because the world is in a slowdown, India's higher. So to me, and just to make this point about valuation, I just want to reel out 4 data points on why this valuation doesn't translate into returns. Okay? So let's take the last 4 years, 2019 calendar years, right? And if you want to note it down, just note it down, because it will show the absolute fallacy of depending on these earnings growth to actually deliver returns. Okay? I'm going to take the 4 years, 2019, 2020, 21 and 22. Okay? 4 calendar years. I'm going to give you the actual earnings of the Nifty. Okay? 19, it was 4%. What return did the market deliver? 12%. In 2020, it was minus 4.7%. What did the market deliver? 14.9%. The next year, the calendar EPS was 16.8. The market delivered 24.1. And hold your horses. The next year, calendar year 22, the market delivered 34.9% EPS growth. Market return was only 4%. So you can say the market delivered 35%, my stocks should have, my market. No, because what does the market do? Market is discounting the future, not the present. So every time when you invest today, if you feel the market is overvalued, you have to remember that at the end of your investment horizon, if the people feel the future justification that time is worth it, you will make enough money. So I'll end up with another statistic, right? Of all the last 20 years, if you take the market peaks, at the peak of the market, if you invested, and you stayed invested for 1 year, 3 year or 5 year, okay, your chances of beating 7%, inflation beating return, has been 60% plus from a peak of the market. Right? So that means you have 3 out of 5 chances of beating inflation, even at the peak of the market. Arguably, the market is not continuously at the peak. Right? So my respectful thing is, please ignore valuations because they represent an average of everybody's thinking. Each individual fund manager, each individual person is not investing in the average. He is investing on his own read of that company, the sector, the stock, and the time frame of the future. So as long as your asset allocation is in place, keeping it to a broad market, because newspaper headlines may be about Nifty, but your investment in mutual funds is not about the Nifty. So diversify it across the cap curve and ignore what public speak is about valuations.
So Mr. Sunil, is clear that diversification, across asset classes can basically mean that you can all go home thinking that the market is going to grow. So all this discussion is, for entertainment for now. But we wish it were the case, but unfortunately for investors, as long as the going is good, we are all willing to stay invested. The moment, we think that things are not going well, we would like to, be rescued, right? So that's what the fund managers challenge is too in terms of, retaining assets. But yes, the point that as retail investors, thinking long term and asset allocation, of course, especially when you invest through mutual funds, is the way to go. But when you start picking stocks, some of these things will start mattering to you. Now, on that note, Mr. Ganesh was very positive about the capital goods, the capex cycle. He spoke about how the PLI is, triggering the growth, etc. So, my question there is whether we should have relook at the way we look at the manufacturing sector. Manufacturing sector has traditionally been asset heavy, high working capital intense, and sometimes they get into trouble, debt laden, and they have cycles. Many of the manufacturing spaces, none of it is very steady. They have their cycles, but something seems to be shifting in terms of what we are seeing today in the manufacturing space than we saw a decade ago. I was myself tracking the capital goods sector, and I can see a significant shift in the way companies are operating in this space, and the valuations that they are commanding now. So is it time to take a different view of how we look at this segments, Ganesh?
Totally. Okay. And I'll give you the key reason. Okay. First, let's look at sectors like cement or steel or telecom. Let's look at a sector which many of us relate to, aviation, right? Why has Air India and Indigo, why have they each ordered 500 aircrafts, okay, in the last 3 months? The reason is not demand suddenly. The reason is preemptive or predatory strategy. They want to make it a duopoly, okay? So to make it a duopoly, to ensure that the next 10 years, new supply doesn't come with added aircrafts, they are putting capacity. Same thing is happening in telecom, 2-player market. Take steel, 5-player market. Cement, 4-player market. What used to be 10, 15-player markets have become 3, 4-player markets over the last 10 years. NPAs have come, they've all gone, merged into the Ultratechs and the Tata Steels of the world, or Air India has now gone into Tata's hands. Consolidation, okay? Consolidation of market shares has resulted in a very unique competitive scenario. I can draw this example for maybe 20 sectors. Take sectors like pipes or cables, okay, or property. You'll be stumped at number of property developers post RERA implementation, how it's come down in each city, okay. So what I'm referring to basically is over the last 5 years, of a few, top 3, 4 players in each sector have disproportionately gained market share, and to keep their market share intact for the next decade, they are planning capex. Their balance sheets are in great shape, as I told you, and their capacity utilizations are in the mid 70s to about 80, in some companies even mid 80s. So capex takes time. It takes 2-3 years to get the new capacities in place. So every sector which of relevance, and I think unlike the previous cycle, to answer your question, which was power sector dominated or infrastructure dominated, this time it's going to be 30 sectors. Okay, I'm seeing small sectors like chemicals and the long list of relatively lesser sized sectors are seeing capex. Second thing, PLI, as you said. We all know, the cell phones now increasingly manufactured in India. Okay, I think if there is one sector where there is phenomenal traction on the ground, it is the electronics sector. Okay, and no better place to do this than Chennai. Okay, you have Foxconn employs 50,000 people in their manufacturing locations here. They're looking to add up, maybe even double up their capacity. So I'm saying electronics on one side and the consolidation led likely capex. I look for some trends like environmental clearances granted. It's up 5 times. Okay, somebody is planning capex, which is why they've gone to ministry, taken approvals. What is different this time? To answer one more point, it's not going to be debt funded. Everyone has burnt their hands, fingers, and so you're not going to find a debt fueled capex binge this time. It's going to be more equity funded, internal accruals. So how we value those companies, how we are going to, how deep cyclical this time it's likely to be, very different. Another thing is it's going to be MNC led capex. So many MNCs I've met are planning capex in India. Okay, so or increasing their expansion in India. That's also going to be less debt fueled as we understand. So this time the capex cycle, and I think it will last maybe if my expectations are right, at least next 3 to 5 years. And how we understand the derived proxies, the companies which will benefit, I think we have to look at it not 1 year forward, price to earnings or EV EBITDA or any of these multiples. It's going to be a very long and a strong growth cycle. That's our assessment.
Thanks. These are very interesting points. One of the points that he made about electronics in the manufacturing space. I mean, the other sectors, at least, you have seen earlier cycles play out how things are. But this electronics boom, I mean, coming from Make in India, coming from various restrictions that the Indian government is imposing for importing, some of the components used for electronics, is basically forcing not just Indian companies, but global companies that look to India for selling these products. Take Apple. I mean, the i15, like he said, you cannot imagine a new product of Apple's that's going to come out of India, right? That's never happened before. So this is, I and my firm also are quite intrigued by the changes that are happening in this space. So every manufacturing cycle has seen newer companies and changes. For example, the just started boom that happened. I'm going to give you a couple of company examples. I should have made this disclosure before. Please do not take any of what is stated here as advice, and or stock tips for any of us. These examples are just to provide insights for you. Let's take, let's take companies, like Bharat Forge, right? Bharat Forge was a forging company. Now it's completely, its annual report, its latest annual report, it starts with the caption, from tonnage to technology. Imagine the kind of, transition that it completely captures the transition that this company has had, right? It's of course very seriously into defense. It's looking at a lot of digital solutions to much of the manufacturing that it has done. It has made global acquisitions. You will see many of our manufacturing companies, Carborundum Universal, a local company, for example. It has been quietly acquiring companies. It is, it has completely changed the way it works. About a decade ago, because it bought some commodity-based companies, it was valued like a commodity company. That has changed, I'm just giving you illustrations of how transition in the manufacturing space is happening. And, electronics is one such space, that is, undergoing a kind of a significant leapfrog, I might say, that's happening because of various government regulations as well. So I can fully kind of understand where Ganesh may be very positive about the sector, but at the same time, Ganesh, I just have a follow-up question. The market has also, as you speak, kind of valued all of these positives, and the valuations in this sector is quite intriguing. Sometimes you don't even know how you afford 60 times, 70 times to these companies. companies like MNCs that you spoke of, companies like ABB or a Siemens, they are constantly overvalued. I mean, overvalued in the sense in absolute terms. So how do you then go about looking at them?
What we are seeing is these are not steady state earnings. They are, if you say some of the capital goods companies, okay, I don't want to take specific stock names here, but their asset turns have halved, okay. Their margin profile has changed, and their indigenization of raw material procurement has dramatically changed. Their sourcing from the parent has come down, okay. Their exports to the parent are rising, okay. So, and balance sheets is where the earning strength comes from. I find very strong balance sheets. Asset turns have upside. Their investments have gone into it, costs have gone into the P&L, but the returns haven't come from those investments made. So to evaluate earnings on low, I won't say low ball, but not at the peak earnings profile. We are somewhere in between, okay? It will be a mistake. Okay, and especially when I find likely earnings growth drivers, and nobody can predict it right. Okay, I could be a sell-side analyst. I am not going to predict earnings right. Okay, operating leverage is actually a beast. Okay, so I am not trying to say that we can predict earnings, but earnings growth having potential non-linearity gives me confidence that even though the stocks have doubled, tripled, or maybe quadrupled over the last 3 years, they are not at peak of the cycle earnings. The end customers' balance sheets are not debt laden for them to stop capex. So the earnings growth can last 3-5 years. So I take confidence that today's earnings, stock prices are not fully baked in for all the future likely earnings growth expectations which could play out.
If I may just add to his point, is that typically in cyclical sectors, right, the V-shaped curve, when you're doing only 1 year forward, right, it's the 3 years later that the earnings are going to come, number one. Number two, in a capex cycle, when you invest, interest and depreciation are initially capitalized on the project cost, but subsequently till the capacity reaches break even, those will be a big drag on earnings. So it's not the price to earnings 1 year forward is not the right way to look. That's why they look superficially to be overvalued.
Right. So the earnings potential may not always be reflected in the price to earnings, is something that we need to understand for various reasons. One, the kind of transition the sector might itself be undergoing, and what he spoke about, the capex cycle. So that's one idea, the manufacturing space that we spoke of. The second thing that we all love to look at and want to make our money from is the small cap sector, right? Who doesn't like the small cap sector? Who doesn't like small cap stocks? After all, multi-baggers lie there, right? But, and all of us think we have found this one multi-bagger, one small cap stock that will grow from 5,000 crore to 50,000 crore. The reason I'm using this market cap is the 500th company, if you take by market cap as classified by AMFI, is about 5,000 crore, on an, that's the market cap. And only 100 companies, in the 2000 listed, universe and NSE have about 50,000 crore of market cap. We speak so much about India's growth, companies moving, emerging blue chips, emerging, large caps and all that, but we just have 100 companies, about 50,000 crore, right? And yet we want this to happen, this 5,000 crore that 5,000 crore company that you pick to become this 50,000 crore, right? And the chances, we took various periods, once when Prime Minister, we did a kind of analysis. The odds are so against, they are not in our favor in terms of picking that multi-bagger. And yet, we do know that is where wealth lies. So, Nishit, it's a tough question for you. How does one, as a retail investor, go about in any market, looking for this opportunity in small cap, and how would you go about, picking?
Sure. So, Investing in small caps obviously has its own pitfalls. Information available in the market is far lower than what is available for the Infosys of the world or the TCS of the world. Apart from that, management quality a lot of times is suspect. So that again is a problem while investing in small caps. But I have a different take on this 5,000 crore market cap moving to 50,000 crore market cap. I believe a lot of companies will move from 5,000 crores to 50,000 crore market cap, but they'll still be a small cap because the larger companies would have moved up significantly. So when I started my investing career, the small caps we used to talk about was all 300 crore to 500 crore market cap companies. Now that itself has moved to 5,000 crore market cap companies, which means it's already a 10 bagger. So that I think because of the sheer movement of market cap for Indian companies, because of two things. One, obviously earnings growth for Indian corporates, and there is some survivor bias over here because we don't capture in companies which have died off in the way. But because of earnings growth and then multiple re-rating of these companies, I think has led to significant amount of companies being multi-baggers. Today's small caps are still being multi-baggers for a lot of people. Right? So when in 2003, 4, 5, I think, the small cap for us used to be a 200, 300, 400 crore market cap company. And those same companies are now 5,000 crore market cap companies. So anyways, they have been a 10 bagger till now. But obviously, see, most important thing for me when I look at small cap is that is it addressing a market which is big enough for it to grow in future? So the addressable market size needs to be significant for that company to grow. If the company is in a very niche space, which is a very small area, the growth cannot be big because the company cannot be bigger than the industry it is in. So that I think is one important area we look at. Second, obviously, is management quality and management's focus on cash flows, because I think the single most important reason why companies have failed in India, obviously there are many reasons, but the single most reason why companies have failed in India is lack of focus on cash flows. Promoters focus on growth, promoters focus on revenue, but once you stop focusing on cash flows is when everything goes for a toss. So there are companies which grew revenues by multifold, supplying to government, working capital receivables got stuck, and obviously they started defaulting. A lot of those companies were up for block and got sold in NCLT in pittance, right? So focus on cash flow, I think, is one of the most important things one needs to look at while investing in small cap companies, because earnings can be made up to a great extent, cash flows cannot be. So that's where details lie. Apart from that, I personally believe that when I invest in a small cap company, the promoter needs to have significant amount of skin in the game. So if the promoter himself owns 10-15% of the company, then I don't think so has enough skin in the game. You would ideally want the promoter to have higher holding in the company so that he can also reap the benefits of the growth which he can drive for the company. So yeah, that's there. And I believe that if you can pick up companies which have an ability to generate value, either through cost optimization or process innovation, which can provide value to its consumers, either through low cost or better products, I think those companies have a strategy to win in the market. So that's one more area where one needs to focus on while investing in small cap companies. But mentioning small cap companies, in the last few years, and this is the data which we track since 2012. So it's almost 10-year-old data. In the last few years, this year has been the first year when ROEs of small cap companies have exceeded Nifty ROEs, right? So in terms of efficiency, Because ultimately this is, this shows efficiency of capital deployment. In terms of efficiency, now small cap companies have also become as efficient, probably more, but at least as efficient as large cap companies in terms of utilizing the scarce resource of capital. So again, so that's an area I think which is interesting to us. Though we manage diversified equity portfolios, I think significant part of our portfolios are small cap driven, and it's been good experience for us still.
All right, Nishit. So I'd like on the same subject to kind of follow up with the two of you. Sunil, as you run a fund house, it can be quite challenging in terms of deployment in small caps. We constantly see small cap funds closing and opening, because deployment can be a challenge. How have you been managing this, challenge, and what cues should investors take, when this is a question that, investors keep asking. If a small cap fund stops inflows, does that mean that the fund is wary? What exactly happens within the fund house?
So the reason a small cap fund would stop inflows is because he would have taken exposure to more than 100 plus stocks already, right? And finding new investable opportunities beyond those. Because in small cap, there's a regulation that you can't take more than 10% of one stock. Plus, there's a regulation around how much of that free float that you can own. And there are internal regulations around whether you become then as big as a promoter, right? So within the fund house's realm of things, if he finds the investing opportunity is less and he doesn't want to go into a sector where he doesn't have comfort, then the right thing to do is stop. Doesn't mean all other small cap funds will also stop, because each fund manager has a different perspective, number one. Number two is the timing aspect, right? On what time frame do you give to this? Because what has happened in the small cap space is that the prices have run ahead of earnings, right? Typically. And the reason for that is that if you take the small cap index, the largest weight is the industrials. And like he said, in the capex cycle, what happens in the small cap space is that you market first prices the expectation of an order book. Then it follows the actual order book. Then it follows the EPS, and in the middle comes the extra capital needed to build capacity to execute the order. So based on the composition of SIP flows in that small cap fund, you can take that much of a longer view and hence take much more money. So whether you're getting lump sum flow, so very often you will find they stop lump sum, but they continue taking SIPs because that. The other thing is also is what I think he mentioned very clearly is the valuation metric, which is more often used there, is more of price to book or perhaps price to cash flow. So when you use those kind of metrics, you get a different, the market as usual. So I think that it's not an easy answer to just to say, but generally speaking, like I said, I would recommend everybody to look at a SIP as the best way to enter a small cap, because not only do you benefit from the long-term approach of investing, but you also get rupee cost averaging, because it is also by inherent nature more volatile. So for any investor, I would say small cap, SIP has to be the route that you adopt, where you will benefit both ways.
Ganesh, this question is, people can make money in small caps, but before they encash it, it's all gone sometimes, right? So how does one go about booking profits at the right time in small caps?
Actually, as a house, we have never taken a call whether money should be deployed in large caps or mid caps or small caps. There are badly managed large caps. There are extremely well managed small caps. So when it comes to small cap investing, what we recommend is, do we know the promoter well? Is he a diligenceable management quality? It boils down to management, not valuations, not businesses capability. It is management quality. Okay, governance capability, credibility, because track record is not known. Do you know him well? Are you able to diligence the business or the people well? So we've never told we prefer large caps over small caps or vice versa. Okay, it is purely about, especially when it comes to small caps, it is management quality. Okay, and If you get that call right, you will get your small cap call right. If you, as he said, hold on to 3 years, you cannot lose money in small caps. However, valuations you bought in, because small caps by nature, they will be, it's like a 10-year-old boy, okay? How much ever you badly grow, at 18 he will be taller, okay? So the point is, a small cap is basically like betting on a 10-year-old boy, right? So at the end of the day, that quality of nourishment, or how well he's being built for the future, that's what you tend to watch, than just small cap being a category and ignored or liked. That's my submission.
That's where Nishit also mentioned about promoter skin in the game. You need the parent to give the nourishment, right, to the company. So that matters. Also, when both Ganesh, Nishit, everyone here basically said about the quality of management, the quality of company, you can actually see it in the differential valuations that market affords. I mean, the market, after all, is a collective wisdom of all investors. So if you take a sector like, for example, I mean, we spoke about a lot of sectors, but not the one big sector that moves the indices, which is the financials, right? We all know about banks already. I mean, banks, between retail banking and corporate lending, they go in cycles. So sometimes you pick the retail ones, but the recent performers, the non-banking financial companies or the microfinance companies, right? Many of them were small caps, continue to be small caps, delivering exceedingly well. But you will see a significant difference in the valuation that the market affords to these segments. That, if you observe, will kind of reflect in what all that they said. For example, a lending company with a very clear lending end use. A microfinance, for example. Very clearly, if the majority of the money goes to microfinance and it is deployed well, it is managed well, high ROA, the valuations are different as opposed to a company that simply says it gives business loans. So the end use in an NBFC really determines the ROA and in turn the valuation that it commands, right? This is so for every single sector, and especially when you're a small cap, the business, what business it is into, the sustainability of the growth of such business, all of these come into play. I just gave you an example of NBFC because it's a very in thing now, but you can apply it in each and every, sector in the small cap space, including industrials, and you will see that the market affords different valuations. So that's something that we need to keep in mind. Before I move on to questions, very quick responses I will need. Ennada ivanga summa ella gyanam kuduttaanga. Finally, what are you saying, right? Mela poda kizha poda sideways engalukku you have to give us that, okay? We all like to car ourselves up. So very quick, in the next 12 to 18 months, Sunil, listen, none of you should note this down and ask us the next time we come down, okay? That's not allowed. So what do you expect the markets to behave?
Next 12 to 18 months.
Well, he said 3 years, but I'm again pinning him to 12 to 18 months.
You understand what's happening in the next 12 to 18 months? You have a semi-finals, then you have finals of the election, then you have a US election.
Exactly.
Right?
We have a lot going on out there. Yeah.
So I think that the reasonable expectation is of low double-digit return from the equity market, from the broader equity markets.
Right.
I think that will be fair.
I generally don't make predictions, but I'm not a buyer at these market levels. I'll wait for, as Nishit also said, I'm not, stocks are not in my comfort zone. I'll wait for 10% correction before I will buy.
Excellent. Nishit.
So, I continue to be constructive on the market. I believe low teens is what one can look at. In markets, obviously in between, you might have a 5-7% correction, but from an 18 months perspective, I think a fair assumption should be a low teens kind of growth from the market. But there will be pockets which can deliver far higher returns than the normal market returns.
Right. Okay. As far as I'm
I won't ask you that question.
Yeah. As far as I'm concerned, with all the stuff that we still speak, let me speak on my personal experience and investment. I ruthlessly go about booking profits when I see money. Okay, I do not look back. I have the luxury to do it because it's my personal portfolio. Okay, and I keep a list of stocks, and that's something that we follow in our own firm as well. In our radar, companies that we like, but we are not comfortable in terms of the valuations, right? We put them in a basket, we put them in a bucket and keep observing them. And when markets afford the opportunities, they do sometimes, and they don't. Sometimes you miss the bus, but that's okay because there are plenty of other opportunities out there. But you will, if you put 10 stocks in your bucket, definitely 2 or 3 will reach, the comfort zone that we are talking of. Like Ganesh said, you will always get those opportunities. And my experience has been those opportunities have come during election years, definitely, right? So there's no harm sometimes in waiting it out. So I am a big believer in, booking profits and redeploying where opportunity. I don't stay in the sidelines. I keep scouting for opportunities, and that's what we also recommend through our own firm too. So, okay, now we'll move on to the questions. I have a bunch of questions, and I hope to take most of them. So let me start with this question is for Ganesh. Since you mentioned PLI, can you shed light on your views on the success of PLI scheme, especially auto and textile, and its effect on the market in light of the recent criticism after withdrawals in textile PLI? And calculate auto parts being questioned, auto parts PLI also being questioned. Yeah.
PLI is more on, to me, primarily electronics, second pharma. Textiles, autos, I don't see too much action on the ground on PLI. The top 2 are electronics and its related sectors, and pharmaceutical, especially the ingredients. So that's the only 2 sectors so far that we have seen, not just its impact play out, but also traction or feedback or other channel checks tell us these are the top 2. But that's for now. I think PLI is a 10-year approach by the government. I think it's possibly the best or possibly the most important, the strategic push by the government to get our imports down. Our trade deficit China was getting into almost triple-digit $1 billion. Absolutely unsustainable levels. And we high time needed to get that back in control. And I think all the measures are on the right track. Is it going to play out next 12-18 months alone? No. In every sector, there are 13 sectors, and it will play out gradually over the course of this decade. But to me, it's the most important strategic initiative for the future, which the government has already taken. And so far, it's on these 2 sectors.
Right. Sunil, perhaps you can take this question. We have Afrin from Delhi asking us, what role does the Indian retail investor play in influencing market valuation and potential overvaluation? Basically, whether the whole lot of us sitting here can pull the strings with valuation.
Okay, of the total free float market cap of the country, 38% is FIIs, roughly 20% is mutual funds, and roughly 20% is retail investors. But these retail investors spread across millions of investors, and even the 20% of mutual fund is in turn spread over millions of investors. So I would say that you're a drop in the ocean, because in FIIs, they come at much bigger tickets and much bigger. So our ability to influence the valuations is limited. But collectively, what we have, and this has been proven, is that we can reduce the volatility of the market by buying whenever FIIs are selling. And I think if you take the volatility index of the Nifty and compare it to the world's volatility index, we are significantly less volatile. So I think what we provide to the markets is stability, but not the ability to take the valuations up, but prevent it from falling down. So I think that's a very important stabilizing factor, which very few markets in the world have.
So traditionally, retail investors have always joined the bandwagon quite late, right? I mean, we all know it. We want to see the market deliver and then we enter. So to answer Afrin's question, sometimes, you take sign from the retail investors. If everybody is jumping in, maybe you have to be careful.
No, your best investment advisor is your cobbler. When he is buying stocks, it's time to sell.
Nishit, this is a broader question, and perhaps you can tell us how you factor in technological advancements, digitization, and fintech innovations. Do these influence stock market valuations in India?
Yeah, to a great extent they do. Market is forward-looking, and that's my firm belief. So, any technological innovation, when we started with electrification in auto industry, a lot of players which were predominantly focused on ICE vehicles, the multiples never went up versus any company which was doing work on any component which was going in an electric car. So those companies, the multiples went up even without earnings going up. While for companies which were predominantly supplying equipment or components for ICE vehicle, which is the internal combustion engine vehicles, those multiples never went up. So obviously, market is far forward-looking than we estimate, right? And we underestimate the importance or the wisdom of market to a great extent. This is in auto, but across industries, right? If one believes that tomorrow artificial intelligence will lead to lower demand for IT services or a section of IT services, and companies which are focusing on that business, which is IT services which is more mundane in nature, could see significant amount of derating over a period of time. So the earnings might not get hit because the process might be slow, but the returns will not get generated just because the markets will give lower multiple to that particular stream of revenue for the company. So if you ask me personally, yes, markets will factor in any kind of disruption which can happen because of technology, both positively as well as negatively.
Another question here from Lakshmi Pune, again a broader market question. What impact do global events, trade relations and geopolitical tensions have on the valuation of Indian stocks, say for example a G20 summit? So, look, I mean, all the markets, obviously, it's a global village, so we cannot be entirely, disconnected from the rest of the world. That is a given. But to be able to assess every event that happens globally to what its impact would be in India is, I mean, it's like a panel of economists sitting and discussing, and then, an eighth event may happen. 7 ideas may have come up, but the eighth event would have happened. So it's a very hard thing for a retail investor. I mean, it's a job of probably an analyst to, be conscious of that, but for a retail investor to factor in every single thing that's happening, right? I mean, for example, and things change. For example, in 2008, when the global financial crisis happened, we weren't actually directly hit by the global financial crisis, and yet we were the second worst performing market. And why did that happen? I mean, dollar, oil, we couldn't control, our dollar flows. Oil is a big issue for us, and FPI outflow. We were completely at the mercy of foreign portfolio investors, right? So these things, although we were not an external macro event, didn't directly hit us, there are other, issues that can kind of pull us down, and how India has been tackling those issues. For example, we have moved a long way, from being so FPI dependent to becoming more FDI focused, right? FDI is more stable money. So, we are not going to face probably that kind of crisis that we faced earlier. So we need to assess, there's nothing that, you can do about events happening elsewhere. What you need to assess is how can India, contain the downside, if we may call, through its own policies and through its own, macroeconomic stability, etc. And that's what possibly India itself is trying to do at some level. Okay. So as investors, rather than looking at these risks, I would say, look at your own risk appetite, your time frame, and whether if you're invested and you need the money like in less than a year, you have no business waiting, till the nth minute to take out the money. Put the money in a safe place. Very simple personal finance things, 101, which many of us fail to follow, and that results, because we have hundreds of assumptions about macro and none of it is within our control, right? So instead, just look at what is within your control, your own risk appetite and your own time frame. And, to retail investors, that's something that we espouse. Now I'll go to the next question. Maybe Ganesh, you can take this. What do you collectively, so actually for all, what do you all collectively think about FDIs like Morgan Stanley investing in Indian SMEs and MSMEs?
I'm not too sure of that. But I'll tell you at a broader FII level, because we work heavily with FIIs. So I'll give you a sense of how they are thinking today. China is almost uninvestable from their standpoint. Okay, their confidence on China has been shaken, and every incremental dollar coming into emerging markets, nothing in my view, and China is 35% weight, okay, and nothing is going there. Instead, that 35% is coming into Korea, Taiwan, Indonesia, and India. Okay, so I've been interacting with FIIs for 20 years, 22 years. I've never seen the confidence, the comfort that FIIs have on India the way they have it now. I've never seen it. In fact, it's a worry for me, okay, that they have too much of faith. India, in one of the most learned men's words, and I like those words a lot, India has a history of disappointing its optimists and pessimists. Okay, over the years we have disappointed both. So the optimism that is there on India today and the pessimism on China is unprecedented. Okay, and it also has repercussions on FII flows, allocations, and also one of my views is it is not China which is most vulnerable. It is actually US. Okay, it is US where the peak of valuations and peak of earnings are, and it's so if dollar is weak, flows will come into emerging markets, and if it doesn't go into China, I think India will be one of the 3-4 destinations. And broadly for FIIs, I think stability of government, the focus on the formalization of the economy, the tax reforms, the confidence they have on the macro story, and I think that's great news for them.
Great. Sunil, there's a question for you. Does AI ChatGPT create impact on future stock market in India?
Absolutely, it will. That's the way of the world. And I see increasingly algorithmic traders using ChatGPT to make those decisions. And it's take you back to the story of the chess, the super blue computer versus Vishwanathan Anand or with Kasparov, right? So ultimately, if you look at it, I think in the large cap space and in sectors which are heavy weights and well owned, I think ChatGPT will take away those returns because it can act much faster than the human brain to reallocate portfolios. But I still believe in the mid cap and the small cap space, the information asymmetry that exists, I don't think it's still possible for a machine to absorb all variables and put that in. So I see that the implementation of ChatGPT will reduce the alpha in the larger cap, widely held space, but there will still be opportunities for alpha in the mid cap and small cap, where it will take a very long time because it's the index, the information that needs to be fed into that, and all that is still imperfect in a country like India.
Right. So we are, talking of many of these indices that are already there, index players like Morgan Stanley already have many of these indices that use, that's called factor indices, multi-factor indices. It's basically data fed in. I wouldn't call it artificial intelligence yet. there is a difference between giving a set of rules and asking, the system to follow the rules, and for the system to learn from the markets. So for example, you say, you pick stocks based on ABC, say for example, based on price to book, PE, etc. The market learns, if the algorithm learns that, this is not going to work in certain markets and changes its algorithm, then it becomes artificial intelligence. I'm not sure if many of these, factor indices are doing that yet, but perhaps when they do it, factor indices will really pick up in India is, my thought. Nishit, question for you. How does the availability of alternative investment options such as real estate or gold impact investor decisions about stock market participation?
So, all other investment opportunities are competitors to stock market to some extent, right? If money is not going to stock market, it will go to either gold or fixed income or real estate. And especially now with real estate also being paperized to a great extent in terms of REITs or warehousing units which are available in the market on a far larger extent. So yes, these are competitive products, but these are also products from a portfolio perspective, helps in terms of diversification for individuals. And if one can have an ideal diversification for his or her own risk profile, then the movement between these asset classes in terms of allocation will become far less. So probably volatility over a period of time might become far less. But from a short-term perspective, yes, as a competitive product to equities, as and when more asset classes develop, including say probably art over a period of time, you will see some amount of money moving to those areas also, especially from a point of view of diversification.
Right. Okay, we have a student here from Asian College of Journalism. Would you advise investing in IPOs right now? I'm sure all the gentlemen here in their own investing experience are wary of IPOs and, prefer on most occasions to wait to participate. Okay, it's not just, about knowing the company, etc. Look at the, genesis. I mean, why do companies come out with IPOs these days, right? About a decade and a half ago, many IPOs that came, even then, there was offer for sale and there was fresh money raising. Fresh money raising is basically deployed into the company. But a majority that we see today are exit routes for private equity investors. And if somebody is trying to sell and if they have an upper hand, how do you think you, the buyer, is going to get at a good price? As simple as that. That's the first question you should ask yourself, So a big private equity investor is trying to exit at the best of prices. Is that price going to be right for me? That's a question that you first ask, other than, of course, understanding the business, etc. So as in my experience over the past 2 decades, I have watched many fund managers wait. They love some of these companies, but they put them in their, like I said, their list and wait and watch and grab them in good opportunities. That has worked for many portfolios that I have seen. Would I be right in that, Sunil, by and large?
Yes, if you want to invest in an IPO, you should have a 10-year outlook and hang in there. And your point is very good, that is the company raising money to grow its business or is it providing an exit is a very good filter. Never take it into a company where the private equity is existing, because it's the greater fool theory at play, right?
Same, I think a student had another question, Ganesh, maybe you can take it. Are you bearish or bullish about the apparels market? Do you have a view?
So if it is exports dependent apparel manufacturer, yes, I think exports are a vulnerable segment in general and apparel specifically. But if it is a domestic apparel brand, if it is backed by a strong management and a brand which is, of course, why not? I mean, so apparels, apparel brands have created wealth, and if there are some of them are well managed company, for sure.
Right. I'll have probably a couple of questions before we wind up. Nishit, again, a broad, macro question. If the US hikes interest rate again, how will the market react?
So the expectation is that, the current market is pricing in probably at best one more rate hike from US. If the market gets a view that there could be further rate hikes apart from a 25 bips rate hike, then I think markets will be disappointed and there could be a short-term spike in volatility. But so one more rate hike, 25 bips, I don't think so is a major concern. Probably after that, market might see slightly more volatility. More importantly, what is the extent or the time period between the rate hike or stable rates and then a rate cut is what market is more concerned about. If we are at the current rates for longer, then I think there could be increased volatility especially in the US markets. May not necessarily be in other markets, but especially in US markets to a great extent. And in the short term, you might see increased volatility even in other emerging markets.
Okay. Yes, please.
It is not rate hikes I'm worried about. It is actually rate cuts later on that I'm more worried about. Okay, why is the central bank hiking rates? If the demand scenario is better than expected, if inflation is higher than expected, if jobs are more than they feared, they are hiking rates to slow down the economy. It is the slowdown that I'm worried about. Will the extent of slowdown be so much that they might actually be forced to cut rates later on? That's actually my bigger concern than just rate hikes.
Absolutely. I think I share that concern with Ganesh, and we have seen, periods of such rate cuts, and followed by slowdown in growth. For a growing economy, some amount of, rate being up there is actually can be a positive. So we will wait and watch. But yes, I do share those concerns. I think since we are running out of time, I'll kind of wind up. One last question, great. Okay. So one student here from Asian College of Will, the BlackRock, ETF. Okay, BlackRock Geo Venture changed the asset management scenario in India, right? Okay, I will probably take this because we have competitors here. So let me just... So we do know that BlackRock was in India earlier in tie-up with DSP and, exited the market and is back again. And we all know, whether we love Reliance or hate Reliance doesn't matter. We do know Reliance comes in a sector with a kind of a competition killing strategy that it is known for, right? I'm not particularly saying that it is going to do it again with the AMC space. But for investors, forget what happens to the industry. For investors, I think this passive, investing, ETFs, etc., which all these global players are anyway known for, can be a game changer in terms of, getting low-cost products and getting higher exposure to newer themes across the globe, right? That's something that we are observing. Over a decade ago, when the outperformance of active funds was even 8 percentage points, 10 percentage points over indices, anybody would have laughed at the idea of passive investing in India, right? Investing in index, why would you invest in index when an active fund gave 8 to 10 percentage points more? But that's no longer the case, right? Quite a few things have happened. One, the index composition. It has made it harder for funds to keep pace and beat the index, primarily because there are also restrictions in terms of how much they can invest, the weights they can take. And there is also SEBI's category, which really defines the universe of stocks that mutual funds can invest in. Both of these have seen the margin of outperformance of mutual funds shrink in the past 5-6 years. So to that extent, passive investing is something that has gained ground, and it will be interesting to know how large players such as these take it to the next level. So to that extent, these changes are welcome for you as an investor. For the industry, we will have to wait and watch. I'm sure Sunil will do the same.
Yeah, actually, I think it's a very good development, though, as a competitor, because I think it's going to serve the purpose of expanding the market. Mutual fund penetration in India is still in the low double digits. So the amount of money that that combination can bring in to bring new investors into the industry, which then can become a good hunting zone for existing alpha providers. So I think it's a welcome thing that anybody who's willing to burn cash to expand the market is welcome.
Great.
Right? So I think not to worry, it's something that's very good for India.
Great. So to, wind up, I mean, I'm sure you all have got some insights on sectors, on, your perceptions on what, the market can do. So before I end with my final, statement, can we have the vote again on how many of you think that the market is
Before that, I
overvalued?
just want to make one clarification. Since I said don't bother about valuations, right? I just want to clarify, I meant that for a mutual fund investor, not for an individual stock investor. It doesn't mean you go and buy a stock careless of valuation, but when you're doing in a mutual fund, don't bother about the market valuation in allocating. That's what I wanted to clarify.
Excellent. So can we have the vote, please? Those who think market is overvalued? 3, 4. Okay, it's. Are you the same people who raised your hand earlier? Great. So you stick to your guns. Great. We're glad to know that there are contrarians here. So that's good.
Can you rephrase the question to saying, do people think by investing today's market they can make returns?
Yeah.
See, I think slightly different, right?
Okay, so can you make returns by investing today is the question that we'd like to pose now. What period? Long term, obviously. We are all retail investors and we are hoping it's long
That's
term.
3, 5 years. I see a
Okay,
lot
it's
more hands
divided,
going
yes.
up. So
Excellent. So if you're a retail investor, you're investing for the long term, the question of market is overvalued or what, then your answer clearly is so what, right? So with that, let's end this discussion. Thanks.
I fully agree with the panelists. I fully agree with the panelists. Yes, invest in MMA, you will intellectually be very rewarding. Maybe big round of applause to our panelists, Sunil, Nishit, Vidya, and Ganeshram. I now request Anand Session, member of Managing Committee and former Managing Director of QB, to step forward, do the honor of presenting the memento. We'll present the memento. Please come. We've got over 800 viewers watching it online. Thank you so much. And what we are giving as a memento is we do a lot of CSR work with poor government school. It's all item made by the poor children. I'm quite sure it'll be occupy the pride of place in your drawing room. Come. Good picture. Thank you, ladies and gentlemen. Good.